Welcome to the March to a Million podcast with Greg DuPont, founder of the Wealth Solutions Network. In this podcast, Greg shares his journey to positively impact 1 million lives by creating an army of financially minded attorneys who embrace an expanded role in their clients' lives. Greg and his guests challenge the status quo in the legal profession and the financial services industry, and show attorneys how they can improve their lives, provide greater value to their clients, and experience greater professional satisfaction. Join us in this movement and strengthen your business by learning how to solve your clients' most pressing financial problems.
Hello and welcome to another March to a Million podcast with your host, Greg DuPont. All right, so Greg, today we're going to be talking to John at OneAmerica Financial. What are we going to be talking about?
You know, Matt, when we first launched the March to a Million podcast, one of the initial podcasts that we had, we talked about long-term care and asset-based long-term care, and I got so much feedback from the community that I thought it was time to kind of dive back into this. And John Broyles here is an expert in it with OneAmerica, and so we're going to talk a little bit about some of the things he's seen and making this more accessible to the consumer. So, John, welcome. Thank you for taking time to be with me today.
Well, thank you so much for having me. And it's one of the most important topics, especially in the financial planning process we could ever talk about. So I'm grateful to be here and share my expertise.
You know, John, when I did this before, Jeff Sather was my guest. And you may know Jeff, and he had a kind of a colorful story as to what drove his passion in this particular field. And I'm just curious, you know, what drives you with this particular solution for consumers?
Yeah, well, for number one, you know, I've been a financial advisor myself. I've helped clients manage their wealth, their assets, and a part of that process, something you discover is there's a huge gap and there's a huge need around this topic of long-term care planning. It's typically taboo in our culture, and helping advisors engage their clients and helping clients engage their advisors make the conversation approachable and not something that we just skirt to the side and get to other financial planning topics. So my passion and love is creating vulnerable spaces in which clients can share their own personal stories. And what we've seen is it's happening a lot more frequently now with our baby boomer population aging, to where it's just become more commonplace. And so helping to facilitate those conversations is one of my passions.
You know, I've got lots of attorneys in WSN or attorneys that listen to this podcast that say, you know, I recognize the need, but I can't have these conversations. I have a difficult time having these conversations. How can we bridge the subject with the clients more effectively and efficiently?
Yeah, the first thing I always suggest is, you know, we hear the words LTC or long-term care. And a lot of clients have negative connotation or association with that kind of language and verbiage. And instead, what I suggest is any professional out there is just to share your own story, whether it's a grandparent or perhaps it's a parent, and what your experience was. And commonly for me, now, even though I haven't experienced it in my personal family, I talk a whole heck of a lot about Alzheimer's and dementia. And the reason I do is that this is an ailment and an illness that is becoming very much more prevalent in our society. And it's that kind of ailment that can really see folks having an enduring need for care. And I'll just share, you know, my family next door to me, where the house I grew up, the father of that family came down with Alzheimer's right around age 58, 59, and slowly declined to the point where their son, my friend growing up, had to be the one of the family to take his father in to the nursing home and the memory care unit at the nursing home. And so in sharing such stories, it then provokes or prompts clients to think about their own loved ones, or perhaps they know somebody who has experienced Alzheimer's dementia, but it could be any kind of health-related topic. So when we share our own personal stories, it creates a realness to what long-term care really is. And that can help create that vulnerable space to invite our clients to share their own stories, but then ultimately start thinking about themselves and what their future might be with their own personal health.
I look at the long-term care horizon from different perspectives. We have the real young couples, we have the middle-aged couples, and we have the end stage couples. And when we're more closer at that point to talking about crisis planning and trust and all that kind of stuff, the core of the people, call it 50 to 65, that are concerned about this, or have had an experience with somebody in their family or neighbors like you had, that want to talk about this and see some value to this, but there's the baggage that the label LTC has. Can you kind of refresh, or for new listeners, walk through a little bit of the history of the product a little bit, and why there is that negative connotation, and why to some extent it's warranted, and kind of how the industry has responded?
Sure. So from the insurance side of it, I'll get to that second, but I first want to just talk about long-term care and just the negative connotation with that language, as I suggested previously. I will never forget personally, as a 10-year-old boy, the stench of the nursing home that my grandma was in. Going back to Illinois to visit over Christmas, where my uncle was, my grandma was in a nursing home facility real close by. So when I hear long-term care, that's my association. It's a negative one. I just wanted to go outside and play. It was a very awkward, uncomfortable. The place smelled. It wasn't a great place because my grandparents didn't plan. So that's just one with the verbiage. Now, in terms of long-term care insurance, what we've seen historically, there were a lot of actually terrific policies that were issued, traditional long-term care policies, whereby over time, insurance companies perhaps miscalculated, and there's a multitude of factors that went into this. But bottom line is they'd had to come back to their clients and ask for more premium in order to keep good on those contractual benefits that they had issued. Now, they had every right to come back and ask for those premium increases, but obviously that's not a good thing when a client is not expecting their premiums to go up and all of a sudden they're being faced with maybe 100%, 200% increase in their premiums. There's been a lot of that in the news, but we have to keep in mind that is on an older, what we call traditional long-term care insurance type policy. Now, as a result of these kind of experiences, people have that negative thought in their mind towards long-term care insurance. But what's really been thrust into the limelight is this notion or idea of hybrid long-term care insurance, which is completely different and separate than that traditional form of long-term care insurance. And the hybrid insurance policies are basically based on a life insurance or an annuity policy that perhaps clients already have. And so the context is different, where with such insurance policies, the premiums can never be increased by law, so long as it has certain language within the contract. But almost all hybrid LTC policies, you don't have those all of a sudden spikes in premium increases. And by virtue of being a life insurance policy or an annuity, if it's never used for care, at least there's always going to be something there to leave to beneficiaries. So hybrid LTC insurance has really come along and all but replaced traditional long-term care insurance. Both still exists, and there are different case studies and examples where both might be very suitable for a client.
Now, outside of the industry, OneAmerica is not a company that many people have heard of, but in this space, you guys are one of the leaders in the space. And so can you tell the listeners a little bit about the niche that you guys serve here?
Absolutely. So OneAmerica OneAmerica Financial bought a company called Golden Rule Insurance back in 1988. These policies we've been offering since 1988. Now, don't go out and guess how old I am, but they're just about as old as I am. But we have been doing this just as long, in fact, the longest of any other carrier out there in the space. And with that, we have the experience and have been able to evolve these policies to serve today's current markets, but also have the experience of actually paying claims. So with OneAmerica Financial, we're very proud of the solutions that we offer. And everything that we do is all centered around the clients. So most folks haven't heard of OneAmerica Financial. We are a mutual holding company. And simply put, that just means that the policy holders actually own the enterprise and have voting rights and such. So we don't spend any premium dollars towards kind of marketing or advertising. We don't have our name on any big stadium or billboards out there. So a lot of folks haven't heard of us, but we have become more increasingly popular just as the LTC conversation has become more relevant to folks' financial plans.
So I think it's an important point to underscore. It's a mutual company, not a publicly traded company.
Correct. So mutual holding company as opposed to a stock company. So a stock holding company or a company that's publicly traded, that board, that management team, they have pressures, if you will, to perform on a quarterly basis when they go and report their quarterly earnings to the market, to their shareholders. Well, as a mutual holding enterprise, we only answer to policyholders, not necessarily investors. And as such, we have the ability to simply be perhaps more strategic just beyond, not just beyond next quarter in our financial performance, but for the long term, right? 5 years, 10 years out. So we can make strategic financial maneuvers internally so that we stay solvent, that we can be there for our clients when they need us most and make good on those policy promises that we've made. And I think that just speaks to our ability, the fact that we've been doing it for over 35 years and been able to do it in a very viable sense. I mean, we've paid out over $1 billion in claims last year alone. Now that's enterprise wide, but that's a significant amount of benefits that we're able to deliver to clients, and that's what we're in the business for: promoting, championing lives, and serving clients.
So let's talk about the nature of claims that are typically paid under these policies, not specific to OneAmerica, but in general. These are not policies that are limited to in-facility care. Can you walk through that a little bit?
Absolutely. Yeah. On the claim side of things, if you just think about long-term care services, the people providing this kind of care, it's evolved tremendously over the years. And it's evolved well beyond just nursing homes, right? There are adult daycare facilities that are out there. There are certainly home health care agencies becoming more popular, especially since COVID. You think about COVID, you had a whole bunch of vulnerable folks in a nursing home where COVID ran rampant. People have been rethinking and perhaps thinking that they might want to stay in their own home. Well, there are home health care agencies that will come to your home and provide care where you're at. There's a multitude of different types of care, and it's ever evolving. And even most recently, being able to offer informal care for folks who may not have yet identified the professional caregivers who's going to come in and care for them. Because sometimes long-term care happens in a sudden moment. We may not have a plan yet in place, but being able to provide some benefits for informal care has also been something that has been newer to the marketplace that we're trying to meet that demand and need where clients are at.
I'm not going to put you on the spot for the record on this, but listeners of this program know I'm a big believer in the future and the technology, and I see what's happening with robotics and robots, and I see a time when we're going to make a claim against our policy to pay for our in-home robot that's going to take care of us.
Yeah, I mean, that could very well be on the docket moving forward in the future. And that's where I suggest it's a fast evolving, the types of care being provided in 10 or 15 or 20 years from now. I can't even fathom what's going to be there. But to your point, I can certainly imagine a robotic something that could help mom or dad physically get out of bed and into a wheelchair safely and securely. I have had conversations with folks where a child has attempted that very thing. They've tried to lift their mom or dad out of bed and both wound up in the hospital because they fell over and both injured themselves. So I could definitely see, a place where technology improves, advances to where what we're able to do for our ailing loved ones in the kind of latter terms of their life, and our policies, hopefully will evolve to cover the cost for those kinds of technologies.
Yeah, and without obviously committing to those type of things, but currently these policies, they're also available to tap for funds to make modifications to the house and those type of things to stay at home, right?
Yeah, absolutely. So if someone chooses to stay at home, and as you can imagine, what we're talking about practically is you're losing the functionality, either physically or perhaps mentally. So if we lose the ability, physically, maybe we need to install, handrails in the shower, in the bathroom, just to better aid us getting to and from and just functioning, right? Or maybe we need to install a ramp because all we have are stairs, but now we're in a wheelchair. We need to install a ramp. Our policies will pay for those kind of accommodations if we choose to stay at home. Of course, if someone says, you know what, I know exactly the facility I want to go to. It's a nice facility. I want to be in and around other seniors who might be in a similar situation. We will pay for those kind of nursing home services as well. But there's greater bandwidth, if you will, with these hybrid policies than perhaps there formerly was 10, 15, 20 years ago to allow for such modifications, and it just continues to evolve.
I'm curious, would that advancement or claim for either fixing of the house or whatever before we move in, can you also make a claim for maybe the cost incurred in moving mom and dad to the facility? If you got to pack them up and pay a mover to send mom and dad, are those the type of things that commonly may be covered and under a good comprehensive plan, or are those outside of the scope?
Yeah, costs such as like moving, that tends to fall outside of the scope of the plan. The plan is ultimately intended to pay for, again, the specific care that's going to assist you with that loss of functionality. So if you need help, getting from your bed to the bathroom or getting dressed in the morning, bathing yourself, paying for somebody to help do those things on your behalf are kind of specifically those expenses that our policies are meant to reimburse or cover. So things like moving or just transportation needs is oftentimes those are needs that are there, are not expressly covered. So, and these are all things that will likely evolve over time. I don't want to speak on behalf of our claims team, but it is
I,
an ever evolving marketplace, and that's where One America, we most recently made an adjustment to allow for informal caregiving to be able to get families money that they may need, even if they haven't identified a licensed care facility or a licensed home health care agency. And that's of course on just new policies. So we're making adaptations as the market demands it, but just also as the LTC care provider space also evolves.
so, part of our mission here with this podcast is to inform attorneys on what to look for to further guide their clients. And to that end, there are a couple of things that are either unique to One America or things very limited in terms of availability that I want to give you the opportunity to talk about. And first is the potential for a lifetime joint kind of thing. So tell me about how that fits into a story.
Yeah, absolutely. So to your point, and it's actually unique to One America in the context, we actually used to have a patent on the actuarial calculation of designing an unlimited benefit. And that's most relevant in the context of having a joint case. So if you think of just your average couple, husband and wife, right? Being able to offer them unlimited LTC benefits is perhaps the greatest value proposition in all of long-term care planning. Now, we had a patent on that up until 2020. And even though it's expired, other carriers haven't necessarily come in and replicated it. So, where is that relevant? People think, gosh, an unlimited LTC benefit, I would never need that until you come across or talk to somebody who's experienced Alzheimer's and dementia. We have, care needs. I think the longest paying claimant, I think she's still on claim, has been 18 years. Just think about that. Being in a nursing home for 18 years. Most common plan designs plan for the average, 2 or 3 years. And look, let's just hope the best case scenario, we never see a day in the nursing home. But what's nice about having that unlimited benefit with us, you can confidently inform a couple or even an individual that we'll cover them no matter what the outcome, whether they have an enduring need for care up to an unlimited amount of benefits, or they have 0 days of care and their death benefit from the life insurance just passes to their beneficiaries. So the nice thing about our plans is you can confidently cover any potential future scenario, no matter what.
So can you address how this tool works when you're sitting across the table from somebody that's got um, qualified retirement money or non-qualified non-retirement money? So can you say how that this tool fits into those scenarios?
Yeah, absolutely. And this is the fun part is being able to make our solutions fit in the context of one's financial plan. And I'll share my own parents' story. My dad was the United Airlines pilot. They saved everything, him and my mom saved everything in his 401k. So when it came time to retire, they didn't have cash sitting on the sidelines to put towards a policy as a lump sum. They didn't necessarily have the cash flow to pay on an ongoing annual basis, but they did have a substantial amount of qualified funds. So within the context of their financial plan, it made sense for us to repurpose via trustee transfer a portion of their qualified funds to go and fund their long-term care plan. And there's nothing really unique about what we do. We just package it and bundle that option and solution in such a way that makes it very compelling and easy for clients to access their long-term care if perhaps they are qualified fund heavy. Now, in that light, any client who has means and wealth, it's just a matter of identifying whether it's a non-qualified annuity that we might want a 1035 exchange over to fund their long-term care plan with us. And there's some tax benefits to our annuities if used for long-term care, or whether it is shifting cash perhaps just out of a checking or savings account that might not be earning as much interest as it used to, right? So whatever the client has, we can truly customize and tailor our plans to fit their specific financial plan and their need.
And in our earlier conversation, you mentioned something as well about business owners and how that they have an opportunity with this that they may not be aware of. Can you elaborate on that a little bit for the listeners?
Absolutely. And while it's relevant this time of year, towards the end of the year, that small business owners especially are looking for every possible way to capture deductions, especially if they had a terrific year. Well, within the Internal Revenue Code, certain premiums, if used to pay for long-term care insurance policies, are potentially tax deductible to clients. Now, that goes for any client, but in the context of a business, whether it's a pass-through entity or perhaps a C corporation business, the ability to capture that deduction becomes more approachable and actually more readily available to them. So first and foremost, as I always tell advisors, look, we want to implement long-term care because we know it's prudent to the client and their financial plan. But then there are efficiencies in perhaps structuring that long-term care policy through their business. And we do that such to capture potential tax deductions on the premiums paid. And in the most beautiful instance where this works extremely well is under a C corporation type business. If there are any clients out there that have a C corporation type business, there's a phenomenal way to capture sincere business deductions while more importantly, implementing your much needed long-term care plan.
So I'm going to bring Matt back in here in a moment because I like to have him on the fly on the wall, and because he always has some insightful questions that have been bouncing around. But
Sure.
what I want to impress on a question to you, impress upon to the listener now is if we're having a estate planning conversation with a family that has some wealth, especially if they're not in crisis mode, we have to be talking to them about the fact that they are not self-insured, they're self-paying on this stuff. And so, we are looking for ways for them to have leverage, whether that's from changing the tax perspective of some savings or being able to pay out double your dollars or whatever, or being able to have lifetime covered, taking a sliver of their savings to protect the rest of it. And just to that leverage kind of conversation, John, I know it's hard to say a number because it's so broad from people, but by and large, if we're talking kind of an average investment, as it were, for a family in their early 60s applying for a kind of an average one of these policies, we're not talking about 30, 40, $50,000 a year. We're talking about something much more reasonable than that for most people. Can you give some ballpark so that our listeners can kind of have some context to talk to a client before they suggest they have a deeper conversation with somebody like yourself.
Yeah, absolutely. And in general, our policies make sense for folks who have perhaps a net worth, liquid net worth north of 500,000. I suggest 750. So a little bit more. You got to have some liquid net worth for our policies to make sense, and or income such that you could afford maybe a $5,000 to $15,000 annual premium. $5,000 a year, it might sound like a lot, but that can be very approachable as a starting kind of policy for someone. And to your point, even folks that are ultra high net worth and maybe they got $10 million to their name, they think they could otherwise self-fund. We have clients in that cohort that buy our policies all the time for non-financial reasons. There's a whole host of benefits that come with our policies, namely having an advocate behind you, that is the OneAmerica company, come claim time to help coordinate and pay your bills, pay the nursing home directly, help you find that community, that facility that you may need. And it's not even you, the client, it's the family. So having that family advocate in that most pressing time, and talk to any child who has dealt with it, when that moment comes and it comes suddenly, it can become crisis mode. When you have a policy, that's one part of the overarching plan, but it's such a crucial part that just simply gives families the options and tools that they need to make informed decisions for their family member, aside from the finances to then fund it.
Matt, over to you. You have any questions from listening today?
I don't really have a lot of questions, but I want to recap just a couple of things that were said. I'm going to paraphrase here. I'm not going to quote either of you directly. Number one, we're going to start at the end there, which is, listen, why would you self-fund this? It seems utterly ridiculous to me. The wealthy have always been leveraging the insurance companies to help with this. Why you don't want to do this, that makes no sense to me whatsoever. I've worked with thousands of advisors as a consultant, and we talk about that all the time. So there's number one. Number two, John, you had said something early on with some of the stories that you told. Most people want to age in place, and the flexibility of an LTC policy that you can stay in your home, and that level of flexibility really just helps people live the life that they want towards the end, right? I can't tell you how many stories I personally have of people who want to stay in their home instead of going to a nursing home. That's really important. And the last piece is, this is just planning, man. And Greg and I talk about this all. You have to have these conversations and you have to have solutions because this is what people want, right? I don't care how you feel about life insurance. I don't care how you feel about annuities. I don't care how you feel about long-term care policies. This is what your clients want. This is what Generation X and baby boomers want. They want the protection. They want to make sure that they're going to be covered, and that's vitally important. So, John, if there's people want to reach out to you specifically, one, who should, and secondly, what's the best way for them to do that?
Yeah, anybody who'd just like to learn more about hybrid LTC in general or OneAmerica specifically, by all means, feel free to give me a call. My cell phone is 619-252-8111. Of course, Greg is also an expert in this topic and area and can be a terrific resource as well. But I love having the conversation and just educating. A lot of folks don't know these things exist. We have to have that conversation.
Amen, brother. And Greg, I'm hoping you don't mind that our listeners reach out to you on this either.
John is one of the examples of the resources that we bring to members of WSN. So yeah, absolutely reach out to me. And if we need to bring John into the loop, then we will bring him in.
And please make sure that you add this to your playbook with the March to a Million, with this whole Wealth Solutions Network that Greg has been building, because this is an absolutely fantastic play that your clients want you to go through in the playbook of how they're going to truly be able to transfer wealth successfully onto the next generation. So for Greg and for John, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
Thank you for listening to the March to a Million podcast. Click the follow button to be notified when new episodes become available, and get in touch with our team by visiting our website at www.wealthsolutionsgroup.biz or give us a call at 614-432-8065. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Wealth Solutions Network. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice from qualified financial service providers with any questions you may have.